APC, accounting for your future.
Hi, this is Dave from APC and I'm the course director here at APC. So in this particular video, we are going to be focusing on the introduction to the paper F3 financial accounting of your ACCA. So what the financial accounting actually talks about is for external use, or we can call it as the external accounting. So financial accounting is where the financial accountant preparing the financial statements. So think about it this way: if you are the investor who is willing to spend your money in buying the shares of those different companies, the first thing you need to do is to have a look at their financial statements of what's going on. So if you see that, well, within the financial statements, that company can make a profit of $500, where you simply buy one share, for example, so that you can enjoy this $500 of the profit that the company's made. So for example, you spend $1 into the company so that the company can provide you with $500, for example. So that's called the return on investment. So that is 500 times over the investments that you've made. And hence, of course, surely if I were you, I'm willing to invest more money into that company. So that's what I mean by financial statements. So from an investor's point of view, or from the shareholder's point of view, we are going to use those financial statements in order to make our economic decisions of either to buy a share or sell a share within the marketplace. And of course, we will use those financial statements as well from a tax authority's perspective, because we have to be fair within the society, and hence the company should pay tax to the government so that the government can use those taxes to help with the poor guys within the marketplace or within the society. But how much tax the company has to pay? Because you charge such a high selling price to those customers, and hence you have made a high profit in this year, so that maybe to some extent you need to pay a higher tax expense to the tax authority in that particular year as well. So by having a look at those statements of profit loss, we can estimate how much taxes the company has to pay. So that from a financial accountant's point of view, we need to prepare the statement of financial position, and we can call it as the balance sheet. We need to prepare the statement of profit loss, or we can call it as the income statement, or we can call it as the statement of comprehensive income, as the older terms it may suggest. We also need to prepare the statement of cash flow in order to show the movement of those cash flow from the start of the year and at the end of the year, so that we can show a clear picture to the shareholder what's going on. And also we are required to prepare the statement of changes in equity as well. Of course, we will see that in the due course. So let's just have an overview of what those financial statements looks like. So we've got the SFP. It's just the bits of paper showing the total assets the company has, for example $100. And then we've also got the liability of this company, for example $50. And we've also got the equity within this company, for example $50. But what are they? So the assets, for example, we have got the property, plant and equipment. So for example, we've got the buildings. So buildings, because we can use that building to help us to generate future economic benefit or future economic income. So we're going to capitalize that as the asset within the SFP for the company. We've also got the computer in place as well, because we can use that computer to attract more customers, to process the data, for example, so it can help the company to generate the future economic income as well. So that's the reason why we're going to capitalize as the asset. For a liability, on the other hand, we are talking about the money that we've borrowed from others. For example, we've borrowed from our relatives, from family members, or we're going to borrow it from the bank. So worth at $50. Equity, which is the company's value. So as you can see from an investor's point of view, the first thing you need to do is to have a look at the equity. What the company's actually worth. Here in this case, $50. It is the minimum amount the company's actually worth, because the equity equals to asset minus the liability. If we're going to use those assets, such as the cash at bank, to pay off those liabilities, such as the payable to the supplier, so that it can worth, the net amount of the net cash within the company is still $50, because we used 50 out of this 100 in the first place. And hence what the company is actually worth right now is $50 as the minimum price. Why do I call that the minimum price? It's simply because, think about the Nike. So Nike company has many of its brands, many slogans, advertisement, etc. They're intangible assets. So those are the assets we cannot touch. So if those assets we cannot touch, of course, equity here will only show the tangible asset, which is the asset we can touch, such as the building, such as the cash. But for those intangible assets, such as the slogan, for example, just do it, this type of slogan, has not been shown in the SFP, which is the Statement of Financial Position. And hence, from an investor's point of view, if you are going to buy this business, what you need to do is that you see that the company price is actually worth $50. So that's the minimum price. So when negotiating the price with those shareholders, maybe that will be the minimum price they are willing to accept. So maybe normally into the actual negotiation process, they will require premium, such as you have to pay for me $53 in order to buy this company worth at $50. So anyway, so that's the statement of financial position. Also, we got the statement of loss. So that would be just to be a statement showing the sales revenue minus the expenses the company incur, which will give us the profit. For example, we've got $120 of sales revenue minus the expense of $70. That will give us $50 of the profit. So from the financial accountant's point of view, we have to know how we're going to prepare the statement of loss, for example. How are we going to determine that sales revenue then? Of course, we've got the invoices that we're going to dispatch to the customer if the customer is going to buy products from us. For example, you're the customer, you want to buy the pen from our company, so that you order the goods from our company and the company gives the pen to you before you pay for it. So that's called the credit sales. So at the point the company issue the invoice or dispatch the invoice to you, the invoice amount may show that it's $100 of pen. So we're going to recognize that $120 of the pen. So we're going to recognize that amount into the statement of loss. Okay, so that's how we do it. So in the actual course, I'm going to teach you how to prepare those financial statements. For example, for those sales revenue, the first thing you need to do is not post that directly to the ledger account. But the first thing you need to do is to post that into the books of prime entry. Of course, within the books of prime entry, there'll be a lot of books. For example, the sales day book, the sales returns day book, etc. So we're going to record these figures first into those books, and then we're going to extract that into a payment account later on. So that's the statement of loss. And as you can see, we've got a profit here of 50. And maybe you can argue that profit is before tax, so that you need to pay tax on that particular $50. But the question for that is, how much taxes the company has to pay for? It will all depend upon the tax regulations into your own jurisdiction. So what you need to be able to know then is that you need to know how to provide for the current tax payable in this particular year in the financial accounting as well. I'm going to teach you how in a minute. So that's the statement of profit loss. And also we've got the statement of cash flow as well. So we've got the cash flow statement here, such as this. We've got the blank statements showing the movement of those cash flows. So movements of cash flows all based upon the statement of financial position in the first of our financial statements. For example, at the start of the year we've got $40 of cash. At the end of the year we got $100 of cash. Maybe we sold our plots to a customer so we can receive the cash from a customer. So that increased from 40 to 100. So that it means that the cash has been increased by 60 because 100 minus 40. So that the movement is 60. So why do we increase the cash of 60? Maybe because of 3 reasons, or we can call it as the OIF. OIF. So firstly, it's because of the operation of the business. For example, we sell the inventory to a customer and we got the cash of $20 from the customer. And maybe it will be because of the investment purposes. For example, we rent our factory out and receive the rental income in cash from the, let's say, worth at $10 in each and every year. So that increased the cash up by $10 as well. Or maybe it will be because of the financing operation as well. The financing activity. For example, during the year, I borrow $30 worth of cash from the bank. And hence, of course, the cash balances within a company has increased by 30. So as you can see, 20 plus 10 plus 30, it will add up to $60. So that's what I mean by statement of cash flow. So statement of cash flow is just to show the movement of cash during the year into 3 reasons, into operation, investing, as well as the financing reasons. Okay, I'm going to teach you how in a minute. So that's just an overview. But within the financial accounting, the next thing you need to be able to understand is that within the company, we have got the finance director sitting on top for the finance department, and for the financial accounting here, so under which it will call the financial controller, and under which financial accountant. Not only we've got the financial controller under the finance director, but also we've got the management accountant as well, who is responsible for the internal records within the company, and under which they are called the cost accountant. And below the finance director, we've also got the treasurer as well. Of course, the treasurer, somebody who is mainly responsible for the cash management, and also for the investment, financing, working capital management, as well as the risk management. Of course, we can see that in the F9 financial management, as well as the P4 for our study later on, and under which they are called the cashier. Okay, so those are the financial departments within a company. So what the paper is all about is about this. So what you need to do is to know how to prepare the financial statements for the company, for the SFP, P&L, and the statement of cash flow. So for example, within the assets, we've also got many other items such as the property, plant and equipment, which is the non-current asset, such as the building. How are we going to account for it? We've got the inventory. For example, this pen is holding for sale to a customer, so that's called the inventory. How are we going to account for that as well? And what if this pen cannot be used by the company, cannot be sold by the company because it gets damaged? How are we going to account for that? How are we going to show that amount in the financial statements as well? For example, we sold this pen to the customer, but the customer hasn't paid for us, so that we recognise as a receivable, and you can call it as the debtors. So as a result of it, what if that customer is not going to pay for us? We're going to recognise the irrecoverable debt expense as a result. How are we going to do that? We're going to show that in the actual course. Of course, there will be lots of other theories, such as the conceptual framework that we have to learn. So for example, the aim of the financial accountant is to provide the useful information to the user. So the user will include the tax authority, will include the shareholder, may also include the management of the business, or maybe including the employees within the company as well, because the employee would like to see how much profit the company has made in order to decide whether or not we should stay within this company in the later years. So, in order to provide the useful information, how are you going to define that information is useful? So those are the theory parts we are going to learn. But most importantly in this particular paper is that we need to understand how we're going to prepare the whole financial statements for the company, and we're going to deal with the specific items later on when we come to the course. So that is the introduction to the paper, and that's all for this video. Thank you.
APC, accounting for your future.